floral shop. That's what we're talking about. We're looking at the month of December. And if you remember how to read this report from the columns, we're looking at current year. We're looking at the percent of revenue for the current year. We're looking at the prior year and its percent of revenue. Then we're looking at the change between the periods and the percent of change. Then in sales, you see the lines of business. So we've got a line of business for in-store. We've got a line of business for delivery. We've got lines of business for reoccurring floral sales, wedding floral sales, trade shows, those kinds of things. So what Sarah has done in this example is she's broken out her sales by category, which is a really helpful way to understand and look at which of my products or which of my services is doing better, where am I seeing growth? And it also helps you start to see a little later on, we'll recognize it, where am I profitable? What's contributing most to my profitability? So you can look at it from the point of view of, for current year, you can see my in-store sales were $29,843. So in the month of December, that was the number. For delivery, Sarah had $6,900 in delivery revenue or sales, 49,815 for reoccurring floral sales. So you kind of get the idea of how that works out. Then the next column to the right, you can see that percent of revenue. If you're not familiar with how to calculate percent of revenue, it's very, very simple. Basically, you take your line item revenue or line item, in this case, let's talk about in-store, that 29,843. You basically divide that number by your total sales for the period. Now we don't, you can see that 128,288, that's the total sales for the period. That should be about 23.3% of total sales. Okay, that's the way you figure it out. And that's how percent of revenue is calculated, not only in the sales section, but also in the cost of goods section. And in the case of what we'll look at in a little bit, operating expenses. So now you've got a kind of a good sense of how that's working. You can see how they've broken out their lines of business. You can see how each line of business has contributed to the percent of revenue for the period. And then you can see how it compares to prior years. So what would you guess is the biggest change in sales year over year? What would it be? If you looked at and thought it was wedding floral services, you're absolutely correct, right? You can see that percent of change over on the far right-hand column at 146%. That's where the biggest change occurred. So if you were looking to focus on things that were high impact, that would give you an indication that that's where the biggest change occurred. And also it tends to be where the biggest percent of revenue is, at least one of the top three. So if we drop down, hang on a second, I've got a couple of questions here, or a couple of chat comments. Let me see what these are. Okay, great. Everybody's just putting that information in. Thank you so much for doing that. So that's probably another point to make as we go through this. If you have a question, drop it into the chat box and I'll drop in there and address your questions periodically throughout the workshop. The next thing we're going to look at is cost of goods sold. So you can see cost of goods sold is kind of organized the same way sales is. You've got in-store, delivery, reoccurring, wedding, trade show, and then you've got a couple of other categories down at the bottom there. Discard costs. So discard costs would probably be something like waste. So this is a flower business, a flower shop business, you know, flowers get old, you have to get rid of them. So those costs are included here. And then you've also got some direct labor taxes and benefits that are listed here. So cost of goods sold is something known as a variable expense, a variable cost. And the reason it's called variable is because when sales go up, your cost of goods sold or your variable costs tend to go up with it. Okay. When sales go down, your cost of goods sold tends to drop as well. So these are variable costs that you as a business owner can manipulate, can change based upon the direction your business is going. If your business is booming and you're growing, then you're going to add expenses. You're going to add costs to your business. If your business is contracting, then you're probably going to withhold investment or costs. And that's why it's called the variable expense category. Let's see, we're going to. So we've talked about these, we've talked about the change column. So you get kind of an idea of how to read this report and see how this report works. Now, for the cost of goods sold, this is a roll-up report. So what you're seeing are consolidated information related to costs for under the cost of goods sold. So in store, that 14,937, that's likely to have labor costs. It's likely to have other variable costs like packaging or freight or those kinds of expenses that correlate or track to the volume of sales. So if, for example, if I have a in-store clerk that's working in the store and people come in and buy things, that clerk's salary is included in that 14,937. Hopefully that makes sense, that the notion that that's a variable cost. There are other labor costs that aren't necessarily variable, and we'll look at those in a little bit. Any questions? Okay, the next thing I want to point out here is gross profit. So the way you calculate gross profit is you look at your current year sales or current period sales, that 128,288, and then you subtract from that your total cost of goods sold. So that's 62,173, that's your total cost of goods sold. That gives you a gross profit of $66,115. That's 51.5% of revenue or sales. Okay, we'll use those terms interchangeably. So you can see in the current period with 51.5% gross profit, last year for the same period, there was 49.3% gross profit. So would you say that gross profit's getting better or worse? If your answer was better, you were absolutely right. That's 2.2% better this year than last year. Or think of it in another way, for every dollar that I earn, right? Every dollar of income, I get 2.2 cents more that drops to my gross profit line. That 2.2 cents may not seem like a lot, but that's hard to get. So that's a big deal. That indicates progress in this business for Sarah's Floral Shop. So one of the things that impacts your sales and impacts your ability to generate sales and revenue is your pricing strategy. So pricing strategies are often difficult for an entrepreneur to develop. And one of the reasons is because we are oftentimes driven to compete solely on price, right? We look at what our competitors are doing and we basically price our products based upon what the market is driving. And that's a strategy. But oftentimes, if you use that as a strategy, you might not recognize that you're losing money. So developing a pricing strategy that includes an understanding of your costs is really important. One of the ways to help in driving price as a means by which to compete is by being able to consistently exceed customer expectations. This is a philosophy that we talked about last week, and it's something that many companies do very successfully, which is, I sell my products kind of in the same amount as my competitors, but I exceed my customer expectations by giving them great service or by doing something really remarkable that helps them understand I'm better than my competitors. So having that exceeding customer expectation philosophy is often really helpful when you're thinking about price. What you want to do is you want to create value to the customer that's more than just the price of your products or service. An example of this might be in a service business. Maybe you're a landscaper. I'll use landscaping a lot tonight. Maybe you're a landscaper and you're doing, yard work, and you're, mowing the grass, and you're providing fertilizing, and you're doing that kind of stuff. But on top of that, what you do is you offer information to your customer about different plants that they might have in their yard that may need, more fertilizer or trimming, or maybe you make plant suggestions to them on things that they could try differently, or maybe you create a newsletter on, how to grow a wonderful garden in Colorado. Those kinds of things tend to add value and give your clients a sense that they're getting more than just the monthly fee that they're paying you. And that's really important and helpful in having and keeping clients. Also understanding what the market will bear, knowing what you can charge and what your competitors charge, kind of at the high end and at the low end, is important. One of the ways to do that is by finding industry associations or industry groups that focus on the products or the service or the type of business that you have. And if you can do that, oftentimes these industry groups will generate information about, what the market's all about, the kinds of profits and sales companies have, how they price their products or services. So that's a great way to help you understand the market and understand where and how your competitors work, and where and how to price your products or services. So the question is what are your competitors charging, and how can you distinguish your business and charge more? And again, it's going back to that notion of exceeding expectations and helping your customers understand that they're getting a greater value than just what the service or product you're serving. So another part of the pricing question is understanding if I have my product, right, and I'm selling my product or my service, and I have a cost associated with it, what is my gross profit or my gross margin? And then you may have heard the term markup. So markup and gross profit or gross margin are different things, and they're calculated differently. So we're going to talk about gross profit and gross margin and how to calculate that. And then we're also going to look at markup and how that's calculated differently. So we'll start with gross profit and gross margin. You can see here for sales that we're using the number $167. So that might be one product, or that might be an assembly of products that add up for the period to equal $167. Then you've got less your cost of goods sold. So remember, cost of goods sold is those costs directly associated with selling and providing my product. So I've got $100 identified there, which means my gross profit or gross margin is $67. So if you divide 67 by 167, which is your total sales, you come out with 40%. So effectively, your gross margin percent or your gross profit percent is 40%. Now, if you wanted to calculate markup, so maybe you had a product that you wanted to price, and you knew what your cost of goods sold was, and you wanted a 40% gross profit on that for that sale. So you're trying to figure out how to price your product. You could use the cost of goods sold. So I know it cost me $100 to provide this product, and then calculate out or figure out, decide what you want your desired gross profit percentage to be. And then you just use this formula. So you take your cost, which is divided by 100% minus your desired gross profit. So this would be 100% minus 40%, which is your desired gross profit, equals 60%. So your cost of $100 divided by 60% equals $167. You see how they got that? So in this particular case, your markup and your gross margin or gross profit are the same. It's 40%. But that's not always the case. And you want to make sure that, for example, if we use a desired gross profit of 50%, then it wouldn't come out to $167. It'd probably come out to something higher than that. So that's kind of the way you do this. Difference between gross profit and markup. So next, what we're going to do is we're going to look at a pricing template, which I think is going to be helpful for you in kind of going through and putting this together if you need to do that for your business. The pricing template was one of the templates that I sent to you yesterday evening. So you should have a copy of this in your email. I'm going to exit out here for a minute and change screens, and we'll just join, look for this pricing template here. Here we go. Okay, so now what we're looking at is the pricing or gross profit percent template. And you can see that you've got a lot of fields here. Those of you that are familiar with Excel, you've got a lot of fields here which are yellow. And those yellow fields are where you enter data. If we go down the slide a little bit, you're going to see there are also some empty fields here. And those empty fields are where there are calculations. So you don't want to put data into those blank fields like this one here or this one over here, okay? They're protected, so you probably won't be able to change the formulas, but it's important to just keep that in mind. So what we're going to do is we're going to look at this from the point of view of sort of two ways to look at pricing. The first way is to calculate sales price to achieve a desired margin or gross profit. So remember what we did when we looked at it in the prior slide. We started with what our costs were, and that's the same thing we're going to do here. So the way you would do this is you would basically put in, let's say we're going to put in production, excuse me for a second, production salary. Sorry for my misspellings. And our production salary is going to be $10. Then we're going to drop down here to product costs and or fixed operating costs. And we'll call this inventory. And our inventory costs for this example are going to be $50. Okay. So this is kind of the same thing that you would do with your business if you were trying to figure this out for your business. Then we're going to look at costs variable with sales, and we'll say this is packaging. And usually this is represented as a percent of sales. So we'll use the number 18% here. And hoping me much. So just for a second. Okay, trust me.
Click in a cell first, and then between the E and the F, you should get the little drag bar. But I think you might just need to type.
Yeah, you can see that here. I don't know why it's showing up. Thanks for the help.
That's a lot of 8s.
Why it's showing up more than 18%. There we go. Okay, 18%. And then we're going to drop down and look at cost variable with salaries and wages. And this is going to be sort of overhead costs. So benefits and taxes and those kinds of things. So that's what I'll use here. And again, that's represented as a percentage. So we'll say 34%. So now what we've got is we've got our costs established, right? And we'll come down here and look at what our desired profit is. And that's what this yellow box is and this DP listed here. So our desired profit, we're going to call this 50%. We want a desired profit of 50%. So in this box right here, you can see sales price needed to achieve desired profit. So this is the sales price that you're going to need, $198.13, given these costs that we've added in here. Now, if we were to say, okay, that might be a little too much, so I'm going to change this to 40%, you can see how this number changes. So this worksheet is set up to help you kind of think through what might work best for you with regards to pricing and how to maintain a profit margin on the products or services that you offer. You can also look at this another way, by calculating gross profit based upon a sales price provided. So maybe I want to start with a sales price and then just figure out what kind of margin that's going to generate for me. So here you can, let's take a number of $250 for a product, and we know what the we know what this production cost is. We know what the inventory costs are, right? So we can enter that information. It's already calculated for us what the packaging costs are and what the other variable costs are. So in this particular case, what it's saying is with a total cost of $108, that's going to generate a 43.36% gross margin. And that's what your gross profit is going to be. Sorry, I misstated that. Your gross profit is going to be $141.60, and that's going to generate a gross margin of 56.64 cents. Okay, so that's kind of how this works. You can look at it two different ways. You can look at it from the point of view of figuring out what your costs are, and then looking at what gross margin you want to have. Like we did in this particular example, we said our desired profit was going to be 40%. So that's what we entered here, and that gave us a number of $150.95. Or you can start with a price, and it will calculate out based upon your costs what kind of gross margin that's going to give you. Okay, any questions on that? Okay, so what we're going to do is we're going to go back to the presentation. Sorry for jumping around here, but it's kind of what we need to do to get these spreadsheets looked at. And just a second, we'll jump back into the presentation. Okay. Next thing we're going to look at is operating expenses. And this is something that is different than looking at your sales and your cost of goods sold. These operating expenses tend to be more fixed. Remember, our cost of goods sold was a variable cost. These costs tend to be more consistent and don't tend to vary as much over time, or as the sales go up or as sales go down. So one of the things that's important to see here is that, as I mentioned earlier, under the cost of goods sold section, a lot of these costs are rolled up. And what the numbers that you're looking at on this report are consolidated numbers. You should be able to kind of go to that expense line in your income statement. So if I had if this were automated, I should be able to go to that owner's salary, for example, and double click on that and drill down into that expense. If you are doing your own books and using something like QuickBooks, or if you have a bookkeeper doing something like QuickBooks, a lot of times that functionality and that ability is there. So you want to be able to understand what makes up those costs as you're reviewing these reports. So the same sort of approach applies, right? We have our current year, we have our percent of revenue, we've got prior year or prior period, we've got that percent of revenue, we've got the change, the dollar change, and the percent change. So we can kind of see how that's broken out. And then if we look at the individual expenses, the way these operating expenses are listed, they're broken into labor, and then below that, fixed expenses. Now, there can be some argument that all labor is a variable expense. And that's not exactly true because, for example, owner's salary, right? That's more of a fixed expense. You would expect the owner to take a salary regardless of whether sales goes up or sales go down. The same thing for payroll, taxes, and benefits. You're going to have, if you're paying employees, you're going to have to pay payroll, taxes, and benefits. So that tends to be more stable than if you were going up and down. Contract labor, that could be argued. It's not a fixed expense, it's variable. But the way we've categorized it here, we've categorized it as more of a fixed expense or operating expense. Below that, you can see fixed expenses, you can see marketing and advertising, insurance, accounting fees, location fees, vehicle expenses. All of those kinds of things get added up to give you a total fixed expense and a total operating expense. In this case, it's $56,183, if you can see that number here, right? So if you take your gross profit that we saw in the prior sheet, and you subtract from it your operating expense, this number, you can see that the net operating income or loss is $9,900. That's how it's arrived at. You take your gross profit minus your total operating expenses, gives you your net operating income. And in this particular case, $9,932. There are some other expenses that have to be considered: interest expense, amortization, depreciation, but we're not going to spend a lot of time on that right now. But in a typical income statement, you would want to consider those. Instead, what we're going to do is we're going to focus our attention on those two small green circles sort of in the middle of the page, where you can see the percent of revenue for total operating expenses for the current period was 43.8%. For the prior period, it was 34%. So what that basically says is that we're really not getting leverage or using all of our operating expenses wisely in comparison of last year versus this year. So last year, we only spent 34 cents per dollar, right, on total operating expenses. And this year, we're spending 43.8 cents per dollar. So we're spending more cents per dollar this year than last year. And that's something that you want to look at and evaluate carefully, because typically you want to see yourself leveraging those total operating expenses better year over year. So if this were, without any extraordinary changes, we would hope that this year's percent of revenue would be something less than 34%. Well, what do you do about that? Well, one of the things that we can do is we can take a look at the detail, and we can figure out, why did we have higher operating expenses this year versus last year? And of course, the way to do that is to look at that change column, right? That percent of change and the dollar change. So the first thing we see is that the owner, supposedly that's Sarah, has given herself a raise, right? Last year, she paid herself $2,500. This year, she's paying herself $5,833. So she's paying herself more. That's one reason why our total operating expenses are a higher percent of revenue, is because she's making some more money. Another contributor is the fact that salaries, wages, and commissions have gone up. You can see there, the dollar change is $7,900 between current year and prior year. That's a 93% increase. That's a pretty good size increase. So that's another reason why that's changed. Now, if you remember from the top of the income statement, where we saw sales, we saw that sales increased. So that makes sense that salaries and wages and commissions would also increase in a commensurate way. Another thing that she's done is she's added a profit sharing plan. And can you see that here? That $12,737 for the current year. And in the prior year, there's no number there. It's blank. So she's added $12,737 and more costs to her total operating expenses this year than last year. And that's what's generated this difference, where the percent of revenue is higher this year for operating expenses than it was for last year. If we were looking at it that way, we could kind of understand, okay, that makes sense. I can see why my operating expenses are higher, because I can see I'm getting more money as the owner, I'm paying more for salaries and wages, and I've added a profit sharing plan that I didn't have last year. I can see where those contributions would make that difference. So let's take a look at where Sarah is getting leverage from her business. Well, you can see here, for example, location expenses. Location expenses in the prior period were $4,190, or 5.9%. Location expenses in the current year, dollars were a little higher, right? 4305, but as a percent of revenue, they were smaller. Remember, our revenue or our sales went up, so the percent of revenue for this line item has shrunk. And so you're comparing 3.4% versus 5.9%. So that's a good example of where she's leveraging her investment in operating expense. The same thing applies for general admin. You can see in prior years or prior period, it was 8%, now it's 5%. So that's an improvement, right? Year over year, even though she may have spent like $40 more, the percent of revenue drove her to have a lower percent of revenue for general and administrative costs. Hopefully that makes sense to you. When you're looking at your income statement, you want to be able to drill down, you want to be able to understand where things are changing, and you want to be able to recognize whether the changes are positive because something positive has happened in the business, or they're negative, and you've got to rally the wagons and get people focused on solving the problem. Okay. All right, let's move on. So let's talk a little bit about what are key business metrics, and how do you use them? So the definition here is that a measure of business or operation and performance. That's really kind of what you're doing when you're looking at key business metrics. They should be data that's easily obtainable. So you don't want to make this so hard that you're spending hours calculating this stuff out in order to look at different business metrics. You want to make it easy. You want to make sure that your business systems can capture the data quickly and you can report it quickly, or your bookkeeper or your accountant can report it for you quickly, right? They want to be simple measures of performance. If you get too detailed and too down in the weeds, it becomes really hard to lift that up and understand what you can do about it. They're used to help you and your team stay focused, right? This is the idea that if I set key business metrics or KPIs, key performance indicators, they can help me and the team understand where we need to focus. Think back to that illustration of that guy standing on one foot with all those spinning plates, right? This is how you can see where to focus your attention. It provides quantifiable fundamentals necessary to make better business decisions. That's key here because your financial reports are really the best tool you have to make a good business decision. Your gut is going to tell you one thing, your advisors are going to tell you something, your customers are probably going to tell you something else, but these reports and these key business metrics are really the fundamental way to make better business decisions. The process for doing it, identify the meaningful metrics for your business. My encouragement to you is, don't get it so big that you're tracking, 10 or 15 different business metrics. I'd start with 3 or 6, something along that line that's easy for you to track, easy for you to remember, easy for you to discuss and communicate with your team. Set goals, set what you want, both from a team perspective and an individual perspective. So I talked to a guy earlier today that was working on assigning someone from his team to each one of the expense line items on his operating expenses. Somebody who would be responsible for managing and monitoring each one of those line items so that when they had an issue or a problem, they could get together and talk about it, and there would be one person that would be responsible for helping figure out how to solve that problem or helping report the fact that the problem existed. So an interesting approach to setting goals. You want to develop action plans to help you achieve your goals. Think back to that planning pyramid that we talked about, setting goals, setting actions, setting a schedule, doing things like that. You want to monitor your metrics to ensure how well you're doing and moving towards your goals. That's a big part of ensuring that you're staying focused and ensuring that you're working towards the things that are important to your business. If you do this once a quarter, it's not enough. So my encouragement to you is look at it at least monthly. And if you can create these key business metrics on a weekly basis, all the better. Learn from your shortcomings and failures. Where things aren't going good, learn from that. Figure out where and how I failed, what I need to do differently. And last but not least, make sure that you learn from your mistakes and you celebrate your successes. This is an important part of ensuring that not only do people learn from what's happening, but they get rewarded for what they do well. So here are some examples of key business metrics that might be helpful to you, right? Selling metrics or marketing metrics. Oftentimes as an entrepreneur, a new business owner, this is really where you're focusing your attention, right? Remember we looked at that matrix, that client matrix, and the fact that it was really hard to sell new products or services to new clients. Well, if you focus your attention on how you're doing, you're going to get a lot more feedback and a lot more data to help you make changes and adjustments. So selling metrics make sense when you want to, you're starting your business. So percent of leads generated is a good one. Lead conversion rate. So what does that mean? So if you get a lead in, somebody's telling you something about, they're interested in your product, how well do you convert that into a sale? Percent of revenue growth, sales increase by geographic location. Keep in mind that if you're not monitoring your sales by geographic location, it's going to be hard to see this. So going back to the income statement and looking at our sales, remember how we had lines of business segmented? If you could segment that by location, you'd have that information for you. Sales per employee, sales per product, percent of sales add-on. How many sales am I selling to existing clients? That's a great metric to follow. From a marketing perspective, your growth rates of customers, retention of customers is really important. Transactions per customer, customer or sales generated by advertising campaigns, those kinds of things are important to see. So we're going to kind of shift a little bit from how to build your metrics and what metrics to consider. And we're going to start to talk a little bit about some things that have been problems in the past that people need to be aware of when you're looking at your reports, you're evaluating weekly or monthly how your business is doing, and you're seeing problems show up in your income statement or your balance sheet. So some of the things that are causing those problems might be covered here. It might help you recognize that problem as you're going forward. So the first one is this notion of variable versus fixed cost. And we've talked a little bit about that. But salary versus hourly. So salary, that's when you're an exempt or a non-exempt employee, and you're working with a fixed salary. So I get the same amount every month or every 2 weeks in my paycheck. Doesn't matter how many hours I work. That's a salaried employee versus an hourly employee who gets paid by the hour. So typically labor laws say you work 40 hours a week. If you work more than that, you get paid overtime. And typically that's at a higher rate of pay than your hourly rate. So maybe that's a time and a half. Sometimes that's used. So if employees get used to being paid overtime, oftentimes what happens is salary or your hourly labor shifts from being variable to being fixed because people are used to it. People, work it whether they really need to or not. So a better approach might be to limit your overtime. But if you've got good people that are working for you and you want to reward them for their extra effort and their extra hours that they work, it might make sense to cut back overtime, but increase their salary rate, right? So their hourly rate. That might be a good way to help with that. If you're paying overtime week after week after week, you need to think about changing salaries or adding somebody else to your payroll so that you're not having to pay those overtime expenses and those expenses aren't becoming fixed expenses to you. Another area where typically you can do both a fixed or a variable approach to your business's advertising, right? You can do advertising on a pay-per-click basis, which is very variable, right? You can set it with Google, for example. You can set it so that after you meet a certain threshold, you're no longer advertising because you've consumed your advertising dollars for a period. That compared to flyers, right? So you go to a printer, you get flyers made. That is a fixed cost. Once you get those flyers made, the only thing you can really do with them is pass them out and use them. You don't have a way of cutting that back once you've printed those flyers. So that's kind of the idea of pay-per-click versus flyers. It's important for you to recognize, however, that advertising is one of those categories of costs that oftentimes just keeps going and you really don't see the benefit, or you're not really tracking how effective your advertising is. And so monitoring the effectiveness of your advertising is really an important thing to evaluate. If you're looking at your advertising and you're not, you change something in advertising and you're not seeing a bump in your sales, you really need to go back and evaluate whether your advertising strategy is working for you. One rule of thumb that might be helpful for you is that an effective advertising strategy says that you should be getting $5 in new sales or in sales, an increase in sales for every dollar of advertising. That's a good ratio. $5, an increase in sales for every dollar spent in advertising. If you're not getting that, you need to go look at what's happening. If you're getting 2 to 1, so $2 in increased sales for a dollar spent, then you're probably not applying your advertising very well. And you probably need to rethink how that works for you and redo that. Another thing to consider is sales commissions versus salaries. Sorry, I had to take a drink there. You can do it all sorts of different ways, or a combination of both commission and salary. And it's not unusual for startups to really sort of look at it from the point of view of, I don't want to pay somebody unless they're selling something for me, so I want to put them on more commission. Versus somebody that's 100% salary, who's not really motivated to make sales because they're getting paid whether they make sales or not. So it's important to kind of think through that and know that it's appropriate, for example, with somebody new that comes on board. Maybe you've got a new salesperson that starts with you and you set their compensation up so that they make, you talk to them and you say, hey, I want you to make $50,000 a year. So the way we're going to structure it is $50,000 is going to be your target compensation. And I'm going to pay you $25,000. So 50% of that, I'm going to pay that to you in a base salary. So you're going to get $25,000 of that $50,000 paid to you, regularly. The other half of that, the other $25,000 to get you to 50 is going to be based on commission. So you're going to have to perform and sell in order to get that commission paid to you. So that's a typical way to set that up. That helps everybody understand where they are. That helps everybody understand what the targets are. Those kinds of things are really helpful. Now, one word of warning that I would give you is you want to make sure that if you're putting somebody on a salary plan like that, a commission plan like that, that you document it. It doesn't have to be a fancy document, but you want to write it down. You want to explain what the goal and the quota is. You want to explain what the target compensation is. And you want to make sure that the individual signs it and you sign it to help everybody recall when there's a question or an issue, everybody can talk about the fact that, we agreed to this at some point in time. Another area where this often happens is bonuses or 401k employer contribution programs. These are really great programs for retaining people and helping people feel valued, but you need to make sure that they're subject to the company's profit. So what that means is that if you've got a bonus program or a 401k employee contribution program, you don't pay those dollars or pay those bonuses or pay those contributions unless the company is profitable. And this goes back to what we talked about with the salary compensation. You have to be able to document your plan and make sure that people understand what it is that they're being paid and when they're going to get those bonuses and those 401k contributions. Because if you don't document that and people's expectations get set that, oh, I got a bonus last month or last quarter or last year, I'm sure I'm going to get one this year, but the company was profitable last year and they're not this year, they're going to be upset. They're going to be disappointed. They may, that may cause them to go look for another job. So you want to make sure that you remind people, what the programs are and that they're documented. Some other things that affect cash. If you have a seasonal business where your cash flows are fluctuating or seasonal, you want to make sure that you conserve cash during strong months when you may need that cash later on in the year. You may need to build up inventory for the holiday season. I have someone that does holiday wreaths and decorations, and they need to buy inventory to make those wreaths. So they have to make sure they have the discipline during the holiday season when they make all their sales to set money aside for inventory for next year so that they can afford to buy the inventory for the next holiday season. It may require you to borrow seasonally with a line of credit. That's another thing to consider. It may require some seasonal workforce. This person that I spoke about that does the wreaths, she oftentimes hires contractors to help her build the wreath, parts of the wreath. So recognizing that she's going to need that help allows her to set that money aside and use that for that seasonal work that she needs. Another item that affects cash is this notion of purchasing versus leasing equipment. You want to make sure that you look for used or good deals in equipment like fixtures and furniture and those kinds of things, computer equipment. Don't just go to a retailer and buy it from American Home Furniture. They provide great products. They have great prices, don't get me wrong, but you can probably find used equipment at a lower rate because lots of times people who go out of business or people who are in distress or people who are just done with the equipment oftentimes sell it. And so you look for brokers and people that have that information and have access to that inventory that can help you. One of the interesting things about inventory, like buying parts that you're going to put into your product and sell, is that oftentimes you have to sacrifice profitability for cash. So you might be thinking, what does that mean? So think about it in terms of a lot of times what vendors will do, your providers of parts, for example, they'll provide you a discount if you buy more. So instead of buying 10 every month, if you buy 30, you get a discount. The problem is that if you buy it at 30, right, 30 days worth of 30 days of supply, what happens is you're paying a lower rate, but you're consuming more cash. And that oftentimes is a problem, particularly if cash is an issue for you. So not buying bigger quantities to get a lower unit price is sometimes what you have to do. One of the things that you might consider doing, if you've got a vendor that you're buying a lot of product from, is you might consider going to them and saying, hey, I want a volume discount, but over the course of a year. So I'm going to buy, a year's supply, maybe it's 100 units from you over the course of the year. And if I buy less than 100, I'm willing to pay a little bit more. But if I buy 100 or more, you're willing to give me a cash rebate back. So at the end of the year, we tally up how much I've spent on your product. And based upon the volume, you're going to write me a check. So maybe if I buy 10% more, I get a check back for, $2 per unit price back. If I buy, 50% more, then maybe I get a larger discount back. So that's the kind of idea of getting and working with your vendors to get a volume discount. It helps a great deal with managing cash. Employee ownership incentives. This is another area where people oftentimes get stuck or make mistakes. And it's important to recognize that there's a right way to do this and a wrong way. These types of incentives are really helpful in keeping key employees, and they help employees sort of get a benefit without paying them more money. So specifically, I'm talking about things like stock options. So this is an area where maybe as an owner of the company, I give you as an employee stock options so that if the company goes public, right, those stock options are going to be valuable on the open market. And the employee gets to buy the stock at a lower rate and sell the stock at a higher rate, and they keep the difference. That's a stock option. The problem is that you have to have, much like employee agreements and bonus agreements and 401k, contributions, you need to have a program that is documented on how these incentives work and what these incentives mean to the employee and the conditions around the incentives. The question here is, will the employee retain ownership if they leave the company? That is usually a big red flag and something that you should not allow to happen. If you allow an employee who's got stock options, or if you've given them stock directly and they leave the company, they could create problems for you in the future. I have a firsthand experience of that, where I took over running a company that had been in business for about 5 years. They had some employees that had worked for them in the early days of the company, and they had given those employees effectively stock that allowed them to have ownership in the company. Well, I come along, the company starts to do better, 11 years goes by, and we get ready to sell the company. The problem is now that the people that had left the company, had received stock, but had left the company, they still have control over the stock, which means that I have to, in order to sell the company, I have to get their approval because they're stock owners. I have to get their approval to sell at a specific price, and they drag their feet. They don't like the deal. They tell me that I need to get more per share, per dollar per share. And so it becomes this very litigious and uncomfortable situation. That could have been avoided had we had an employee stock ownership plan that employee had signed that said, if you leave the company, you lose the stock, you forfeit it. That's plain and simple. That would have solved that problem. the key item here is you want to get legal advice for these kinds of agreements. So next, what we're going to do is we're going to talk about a break-even point. And this is a concept where a lot of new business owners and entrepreneurs are looking for sort of what level of business do they have to have in order to just break even, right? So that represents the volume of activity that produces equal revenues and costs. So it's an algebraic equation that utilizes the combination of fixed and variable costs. You remember we talked about those earlier. But in this break-even analysis, what it does is it helps you understand how much business do I have to generate based upon my costs in order for my company to just break even. It's a useful tool for understanding that cost. You can look at a break-even point based upon a day, a week, a month, or a year. So you can calculate it out. It's with the handout, the template that I sent yesterday to all of you. That template will walk you through the process of how to do it. So here's two break-even scenarios to kind of give you a difference in how fixed versus variable costs impact one scenario versus another. So what we have are two cases. Both of them are budgeting to have sales at $20,000 each. So both scenarios are calculating or estimating that their sales budget's going to be $20,000. Their fixed costs in case one is $6,000, and in case two is $10,000. So that's fixed cost. Their variable costs are just opposite. So in case one, it's $10,000. In case two, it's $6,000. So you can kind of see what the variable costs are as a percentage just below that. So in case one, variable costs are 50%. So if they have $10,000 in variable costs and a $20,000 budget, that's 50% of the budget. Same thing goes for case two. They both expect to generate net income of $4,000. So how would that work? What would that number look like where how much in sales does each one of these cases need in order to break even? So we can see here that in case one, where they have a lower fixed cost rate, same budget sales, same net income expectations, they have to make $12,000 in order to break even. But in case two, because their fixed costs are $10,000, they have to sell $14,286 in order to break even. So that's kind of giving you a sense of how impactful fixed costs are to these calculations versus variable costs. As I mentioned, there is a break-even analysis or a break-even template that I sent to you. We're not going to go into it in depth, but this is something that would be helpful to you if you want to look through that and kind of figure out how that's going to work. So a couple of things to keep in mind. Break-even points change as the business changes. So if you set a break-even for a month, you may find that it changes month over month. Some costs are variable, some costs are fixed. So they tend to, it tends to be important as how you classify them, as you saw. Variable costs can become fixed if they're not managed properly. And fixed costs usually have step increases. So what does that mean? A step increase is a situation where, let's say, again, going back to the landscaper scenario, I'm going to bring on a new crew to complement my existing crew. So what happens there is You have to pay for all of this equipment to get the, for the crew to use. And that's what I mean by a step increase. You tend to have a large investment in order to get your fixed costs increased. In challenging times, the truth of the matter is that all fixed costs become variable. I see we've got a couple of comments in the chat section. Let me see what, maybe there's some questions here I can answer. Gotcha. Okay. Doesn't look like it, so we'll keep going. And I'll make sure that Joy Lynn has the handouts. I'll get those to you, Joy Lynn. All right. So this is what the break-even template looks like. And basically the way this works is, you put in whether you want the results for 1 month or multiple months. You add in your sales, your assumed sales. So in this particular case, you can see in the yellow squares or fields, they've filled this in. You've got total sales of $36,440. You look at your cost of sales. Now, keep in mind, these are typically variable costs. So we've got a total cost of sales of $18,347, which means you've got a gross profit of $18,033, right? You take the $36,440, you subtract from that $18,347 to get your gross profit of $18,033. Now you start looking at your operating expenses. And you can see here, we've listed these, you've got processing fees, you've got owner salaries, you've got salaries and wages, and you can see which category they fall in, whether it's fixed or variable. So they can be adjusted if you need to. And so you get down to this point where you have total operating expenses of $21,452. If you've got a gross profit of I think that's 33, maybe it's 93, sorry. If you've got a gross profit of this number, that means that you've got a net operating income loss of $3,359, which is not very good. Then you add on top of that the fact that you need to pay your debt payment. So in this example, we've got a debt payment of $1,477. That means that you've got a deficit of $4,836. So what you want to do is look at the total adjusted operating expenses and other cash requirements. That's $21,798 of fixed costs and $19,448 variable costs. So it gives you your variable cost percentage. You get down here, go back. You get down here and you add in what your monthly profit is. And what it will do is it will calculate out for you what your break-even point is for your expenses. It'll tell you, okay, you need to have, X number of dollars in order to break even with all of these expenses. That's really helpful as a business owner, because as you're going through the month, you can see, am I getting close to that number? Am I going to make it? Maybe you've got some things that are dependent on whether you're going to, hire a new employee or you're going to buy some equipment, but you need to know what your break-even number is and whether you're going to make it or not. So that's a good way to help you understand that. Okay. So we've talked a lot about, these reports, the income statement, the balance sheet. We've talked about your pricing. We've talked about a break-even template. And we've looked at a number of different things that you might find in these reports that are important to look for and understand. So one of the things that you can do as a business owner is you can do all of this stuff yourself and keep these books and manage all that, or you can look for a bookkeeper. And that's a totally legitimate thing to do as a small business owner, assuming that you have enough cash, either through savings or through your business, that you can pay your bookkeeper. That's key. Don't hire a bookkeeper if you can't afford them. But assuming that you can afford them, getting a bookkeeper oftentimes is a really important inflection point for small business owners, because what it does is it allows them to focus on very important things in their business, as opposed to managing all the numbers and doing all the data entry associated with bookkeeping. It's also important to note that bookkeeping is not just an administrative task. Bookkeepers need to have information and knowledge about charts of accounts, bookkeeping transactions, those kinds of things, in order to do them correctly. So when you hire a good bookkeeper, you're getting somebody, hopefully, that has experience and knowledge about how to keep your books properly. So sometimes, when you're thinking about, doing it yourself, a lot of times people think of it in terms of three major tasks that bookkeepers do: bill customers, record bank deposits, and pay bills. But that's not the case, because actually there are a lot more transactions around an accounting system that are required to keep accurate books. So what happens is people just focus on billing customers, recording bank deposits, and paying bills, and they get all sorts of other stuff wrong in their books. And then they realize that they've got a problem. They go to a bookkeeper and find out, I've been doing it this way for 2 years, and the bookkeeper has to go back and restate the books, maybe refile taxes, and that becomes really messy. So some things you want to try to avoid. If you do have a bookkeeper, don't necessarily assume that they're doing a great job. Like anybody else in your organization, you have to make sure, particularly as they're getting started with you, that they're competent, that they've got good character, and that they can get the job done. So you need to be checking in with your bookkeeper on a regular basis. Another thing that you should consider when looking for a bookkeeper, consider hiring through a due diligence process, making sure that they have accounting software certifications, making sure that they have an accounting education, making sure that they have references. If you hire a bookkeeper and she doesn't or he doesn't have references from other small businesses, that's probably a red flag, something that you want to check into, something you want to reconsider. So references are important. Some things and places to go, if you are looking to hire a bookkeeper, here are a couple of websites and organizations that might help you. Bookkeepinghelp.com, the Colorado Organization of CPAs.org, or QuickBooks.intuit.com/live is another website that could be helpful for you. Something else that's important to know as an entrepreneur, when to have a bookkeeper versus when to have a CPA. Now, what you'll find is that the rate for bookkeepers, the hourly rate for bookkeepers, tends to be a lot lower than the hourly rate for a CPA. So typically, you can get by with having a bookkeeper manage and keep your books during the course of the year and be just fine. But a good practice is at the end of a year, before you're doing your taxes, to have your CPA go through the books that your bookkeeper has maintained for you and your company, and just make sure they're in order. They'll give you feedback on how well the bookkeeper is doing, and it gives you an insight into things that you may have to monitor or look at over the course of the following year. So CPAs can do that for you, and also CPAs can file taxes for you. So that's typically something that a CPA will do. They're trained in managing taxes. Typically, they'll cost a little more, but they're usually pretty good, particularly if you work with them over a period of time. Now, CPAs differ from tax return preparers. Now, we're talking now about Hewlett returns, or other companies that do tax returns. They typically have knowledge about their tax systems, but they don't have people that are well versed or educated in tax code. So ultimately what you get is somebody who knows how to process a tax return through software, but they don't have the in-depth knowledge and education that a CPA might have. If you've ever noticed, when you go to have your tax return done with a tax preparer, somebody that does this, in a storefront or whatever, oftentimes what they do is they ask you to sign a disclaimer saying that you are responsible for your tax return because they're just using their software to process the information that you've given them. And a lot of times that'll work if you've got a simple business, but a lot of times that's not enough. So my encouragement to you is think about using a bookkeeper, and then once a year at least having your books reviewed by a CPA, and consider having that same CPA do your taxes for you. So a couple of things that you might do with a bookkeeper, you might look at, and this is something that I would encourage you to do on a monthly basis. You may have key performance metrics that you monitor each week, and typically your bookkeeper should be able to keep the books up and make them current enough so that you can get those reports. But every month, your bookkeeper should close out that period, that month, start a new period, and have statements and reconciliations that you can review. Much like your bank statements, you should be able to look at an income statement, a balance sheet, and a cash flow statement to see how your business is doing on a monthly basis. During that exercise, as you're doing that, you also want to do things like look at your bank statements and reconcile those. Bank statements verify cash transactions are in your books. So your books and the bank reconciliation should be the same. Look for transactions that are originated externally. So something that's originated outside of your books. These might be mobile deposits that you do. They might be mobile transfers that you do on your phone, those kinds of things. Make sure that they get recorded properly in the reconciliation from the bank, and make sure that your bookkeeper and your business books show the same information. Third-party payroll processing is also another area where external transactions hit your bank. You need to make sure they hit your books also. Customer credit and debit card processing. This is another one that's important. If you do business using customer debit and credit cards, you want to make sure that those credit card charges show up properly. On the other hand, you also want to make sure that when you're paying your credit card debt, that your debt, the principal part of your debt shows up on your balance sheet, and the finance fees show up on your income statement. That's an important distinction that a bookkeeper should be able to keep for you. You also want to look at reoccurring electronic bills. making sure that those show up both on your bank statement as well as on your business books. Debt payments, as I mentioned earlier, one amount in the bank account to make sure that you've got that debt set aside appropriately. Look at accounts payable aging report on a monthly basis. So what's accounts payable? Accounts payable is a list of invoices that your company has received from vendors for goods or services provided. So it represents money that you owe others. One of the things you want to check, or you want to make sure your bookkeeper checks, is making sure that all your invoices are entered into the system. Regardless of whether you pay them during the course of the month, all the invoices that you receive during the month need to be entered into the system. Don't get stuck by having an invoice from a vendor and not putting it into the system because you think you'll do it later or you can't pay it, so I don't want it in the system. That's a mistake that a lot of business people make, and that's a big mistake. Even though you may not be able to pay it, even though it may be late when it's paid, you want to make sure that invoice is in your accounts payable system. It gives you an instant access to how much you owe. You can decide separately when you want to pay each invoice. So a lot of times what will be helpful is you're starting to approach the end of the month, you're looking at your invoices that are due to your vendors, and you can start to prioritize. I want this paid, I want that paid. If cash is tight, you may give instructions to your bookkeeper, I don't want to pay any of these invoices. It happens. Sometimes it does. Sometimes cash is tight. But you want to be able to have control over that and manage it yourself, as opposed to having your bookkeeper pay your invoices because they've come due. Sometimes you can't afford to do that, and you need to give that instruction to your bookkeeper. The objective is to achieve a matching of costs incurred in a time period to the same period where sales are earned. You want to look at your loan statements monthly. This is another aspect of looking at documents on a regular basis so that your books are aligned with your bank or your loan agreements or with your vendors. Or for that matter, with your customers with accounts payable. So look at loan statements monthly and make sure the loan balance from your bank or from whoever you're borrowing from is the same balance that shows up as a liability in your balance sheet, right? That's probably a long-term liability, but that number needs to show up and match the loan statement for that month from your bank if you're borrowing money from a bank. Sometimes what will happen, is we'll get into this in a little bit, is those numbers won't match and you'll have to go figure out what to do about it. And the usual cause is that what happens is when you record the transaction, you record both the principal and the interest payment or finance charge payment together instead of breaking them apart, which is necessary. And that throws your balance sheet off. So that's one of the things to look for. So compare your actual loan balance to that of your balance sheet. The principal portion of your balance should reduce the loan balance. Interest portion of the payment should be recorded as an interest expense on your P&L. So those are the kinds of things that you should look for on a monthly basis, right? So this is starting to sound like a lot of effort, isn't it? And it is, but if you get a routine built and set up, it becomes a lot easier to manage. You know what to look for. You can kind of work through that process. Okay, so next we're going to look at applying some critical thinking to a balance sheet review. So remember the balance sheet, the way it was organized. You had your assets on one side, on the left side, typically you had your liabilities on the right side and your owner equity. And so kind of looking at the balance sheet kind of from that perspective. So what we're going to do is we're going to talk about some typical problems where you'll see on the balance sheet that might be helpful to you in recognizing when you've got an issue. The first one is a growing or changing petty cash balance. So petty cash typically is listed as an asset, a cash asset, in current assets on the balance sheet. And usually the best practice is what people will do is they'll set a fixed amount of petty cash. So let's say $200. I'm going to have $200 in my petty cash, and I'm going to use that to pay for maybe food and drinks, or maybe the mail machine or something like that. And every time I spend money out of the petty cash machine or the petty cash balance, I take the receipt and I enter that into petty cash so that my cash balance remains at $200. I get reimbursed for the receipt and my cash goes back and stays at $200. If you're starting to see your petty cash balance grow, what that means is that somebody isn't reimbursing properly the expenses that are coming out of petty cash. Or if you see your petty cash going down, that typically means that somebody isn't taking care of the transactions necessary to get those expenses reimbursed. So either way, if that petty cash balance changes, that's a red flag to you that you need to look at how petty cash is being managed. Another item is prepaid expense balances that never change. So prepaid expense balances are these balances like when you pay insurance, right? I prepay 6 months of insurance, but I actually reduce the balance sheet amount of that insurance by 1 month's amount every month, so that I can look at what the cost of doing business is for a month compared to the revenues and the income that I have. So basically, what you're doing is you're looking at prepaid expenses that show up in March for 6 months worth, and you're saying, oh my gosh, what happened? Well, in fact, you should be amortizing that or recording that over a period of time. You may have large or the same undeposited fund balances. So this is where clients or customers pay you, right? And you've got an account in your chart of accounts of undeposited funds. So these are checks that they've paid you, but you haven't taken them to the bank yet. Well, the idea is that you match that check up with an invoice that you sent them. And when you deposit that check, you reduce undeposited funds and you credit your bank account. Well, if that transaction isn't being done properly, what you'll see is your undeposited fund balance will grow because somebody isn't matching your invoicing and your payments together and showing that reduction in undeposited funds. So that's a red flag and something that you should look for in the event that that happens on your balance sheet. Another thing is looking for equipment or fixtures or furniture that's recorded as an expense. If you recall, our income statement has a line in there for fixtures, furniture, and expenses, right? But typically, if you're buying equipment or furniture or machinery, typically that has a life longer than 1 year. And if that's the case, you should be putting that on your balance sheet and depreciating that month by month, as opposed to recording a big cost on your income statement once. Don't do that. Look at it, identify whether it can be depreciated over time, if it's really an asset that you have, and put that on your balance sheet, not on your income statement. If you have unusually large office supply expenses, that's another thing to look for. They'll show up on your income statement typically, and if they're 10 times what they were the month prior or the period prior, then investigate that. It's probably something that's been misclassified, a piece of equipment or a piece of furniture that should show up on your balance sheet, not on your income statement. Refundable customer deposits recorded as revenue. So refundable customer deposits are times when a customer may pay you. Maybe they give you a deposit if you're a roofer. They give you a deposit that's going to be refundable at the end of the job. Or maybe you're a landscaper and you get a deposit. And the idea in the agreement that you have with the client is, I'm going to return that deposit to you. Well, you can't record those deposits as revenue because they're not revenue. You're going to give that money back. So they show up as a liability, a short-term liability typically on your balance sheet, and you shouldn't classify them as revenue. Now, if you do, what you'll do is you'll inflate your revenue inappropriately, and then you're going to be stuck when you have to provide that deposit back. So that's usually a thing you can avoid by just recognizing refundable customer deposits show up on the balance sheet. They don't show up on the income statement. Negative liability balances on the balance sheet. If you have a negative liability balance, whether it's a current liability or a long-term liability, you should look at that closely. If it's a negative balance, something has gone wrong. You've got some sort of balance sheet transaction error. It's only rarely, and that should be done only by a CPA or your CFO, only rarely should you ever see a negative liability balance on your balance sheet. So again, if you're looking, in your monthly reviews of these documents, if you see a negative balance on there, you should be going back to your bookkeeper or looking at transactions yourself to see what's driving that. And some of those reasons that we've just talked about may cause a negative balance for you. Credit card payments are another thing that oftentimes is problematic for small businesses because you've got a company credit card. Maybe you've got multiple credit cards out there and your shipping manager has one, or your production manager or your sales manager has one. And they're using those credit cards and incurring expenses on behalf of the company. That's typical. That happens a lot. And that's actually a good way to manage your credit card spending. But there are a couple of things that you have to be aware of and learn. One is that if you've given out this credit card, the holder of the credit card needs to ensure that every week they submit expense reports for their expenses that they use the credit card for. And my encouragement to you is every week. I used to work for a company, 110 employees. Most of us traveled for work, and we all had company credit cards. And the CEO of the company worked with the accounts payable clerk to say, I want to know who has spent money on their company credit card but hasn't submitted an expense report for that this week. So every week she would provide him a report of people that hadn't submitted expense reports. And if you were part of that list, you could expect a call from the CEO who would basically say, get your expense reports in. And if it happened too many times in a row, he would basically take that credit card away from you and suggest to you that you have to use your personal credit card in order to pay for your travel expenses. That was a pretty sobering thing if that happened to you. And usually employees left when that happened. So think about that as a way to manage your credit card spending. Everybody that has a company credit card submits expense reports for those expenses each week. Another good practice is that you may have a company credit card, maybe it's an American Express card or a Visa card, that's supported by the company, but the employee's name is actually on that card. So the statements go to the employee is responsible for paying the bills. And the way they do that is through their expense reports that they submit. So obviously you have to process expense reports quickly to get payments back to employees so they can pay their bills. But that's another way to do it, is that notion that, you know, employees have a company credit card, but the employee's name is on there. If there are unpaid balances from the credit card company, the employee is responsible for that. So balance owed on credit card payments is a balance sheet entry. Finance charges, profit and loss statement or income statement. So that's an important thing to keep straight and make sure that you have them recorded properly. Another thing that often happens is individual charges, so those expense reports are missing. And it's really difficult for your bookkeeper to know when somebody has spent money and you know, an expense report is coming. So a lot of times what's helpful is to request anybody that has a company credit card, if they don't have expenses for that week, to send to your bookkeeper or to you just a quick email that says no expenses this week on the credit card. That helps people know I shouldn't expect an expense report. Credit card statements should be reconciled to account systems each month. You should make sure that your credit card balance shows up on your balance owed shows up on your balance sheet, and that the finance charges that you paid in the prior month show up on your income statement. Okay. If you don't get this from your bookkeeper, you should request a copy of the reconciliation every month from your credit card statement. That's another key report that you want to make sure you get every month. So another problem that often shows up on the balance sheet that might impact the income statement also is when you sell your products, oftentimes it's your responsibility to charge sales tax for that. And that sales tax oftentimes is a city tax that you have to calculate, as well as a state tax that you have to calculate. So when you sell a product, you have to know what your state tax and your local tax or city taxes are so that you can create an invoice that reflects the right amount. You want your customer to be paying those taxes. You don't want those taxes to be coming out of your pocket. So your point of sale provider, right, if you're using Square or if you're using some other point of sale application, they should be able to break that out for you so that you see your product sales amount, you see the city tax amount, and you see the state tax amount. So you want to make sure that they're separated that way, because if you lump it all together and record it as a sale without separating out the taxes, you're going to do a couple of things that are going to be harmful to you. First of all, you're going to overstate your sales amount, right? Your income statement, your sales section, remember that sales section on the income statement is going to show that you're selling more than you actually are, because it's going to contain sales tax that shouldn't be in there. The other thing that might happen is that you might be paying commissions on the sales tax component of the products that you're selling. That's a problem, and you definitely don't want to be paying a salesperson commission on the sales tax portion of the sales that you've done. So something to look forward to, or something to look for when you're considering sales tax. Sales tax paid and charged to cost of goods sold or operating expense distorts gross profit. If you're collecting taxes, this creates a fiduciary obligation, a liability to pass the taxes collected onto the appropriate taxing agency. So generally, the way this works is during the month, you will collect taxes from the sale of your products. And when you get that cash, you know that you've got to put the tax portion of that into accounts so that at the end of the month, you can pay what's owed to the city and you can pay what's owed to the state. And you've got a good accounting of what that is for sales during the course of the month. You got to put sales tax collected in a sales tax payable account. It's a clearing account for each city or state, and it's separate. It's not a combined account, it's a separate account. This is a current liability section of your balance sheet. So that's where it should show up. It's a liability. So you've collected those sales, right? And you're going to have to pay them. That's why it's considered a liability. So that's where it's listed. And you hold that until the file, until you pay your monthly tax bill, right, to the city or the state. And then that number should come down. That current liability number should drop based upon the fact that you've paid it. But because you've kept those funds separate, you've got the money available to go make those payments, those tax payments. Hopefully that makes sense, because that's a lot of times that's a tough thing to do, is to manage sales tax. And if your bookkeeper's not familiar with the tax code and what's required, that's something that you may have to help them with. Last thing we're going to talk about is owner distributions. So if you're a limited liability, an LLC, or an S Corp, or a subchapter S Corp, your shareholders are going to have the ability to make owner distributions or draws, which are legitimate, from the business. Oftentimes, this is done to help shareholders pay taxes, right? So they calculate out what their tax liability is, and then the company pays those taxes through an owner distribution. So it's a legitimate way to do it. If you're taking distributions or dividends from the company, this is not salaries now, this is draws or dividends from the company, they're going to show up on your balance sheet under the owner equity section. The issue is, and where typical problems show up, is that every year that number has to get reset to zero. So what happens at the transaction that your bookkeeper or your CPA will do is they will take any draws or dividend payments or distributions that went to owners, and they will apply it to retained earnings, which is another item on your balance sheet. So they'll take that and charge that to retained earnings, and then your owner distributions will reset to zero. So if you're not resetting to zero every year, you're going to have a problem because your retained earnings are going to be wrong. So the intent is to show the amount of owner distributions only in the current year on your balance sheet. Everything else, prior years, shows up in a single line item called retained earnings. At the beginning of each year, and this is the transaction I was mentioning, prior year's distributions should be transferred to retained earnings. So what is retained earnings? So this is the intent here is to show the cumulative prior year earnings as a line item, right, on your balance sheet. So this effectively gives you an idea of the profits or losses that you've had over the prior years and what their accumulated effect is on the current year. So your retained earnings is hopefully a number that's a positive number, which means you have retained earnings in the business over time to create this account or this amount on your balance sheet. Hopefully that makes sense to you. So next thing we're going to do, just as we kind of wrap up here, something that I sent to you if you were in last week's class. I sent to you the glossary of financial terms, as well as a monthly review checklist. And I would encourage you to look at that monthly review checklist every month, because it gives you a reminder of things that you should look at, things that you should be evaluating on a monthly basis with your bookkeeper, if you have one, or with your CPA, or if you're doing it all yourself, things that you should be looking for as a checklist item. This will be really helpful to you and give you insight into how your business is doing. And if you don't have a habit of doing it, this checklist is a good way to refresh your memory. Okay. So that's it for the presentation, the workshop today. Hopefully you got some information that will be helpful to you. Hopefully the pricing template and the break-even template will be helpful. If you have questions about them, you have my email address. Please feel free to reach out to me. I'd be happy to walk you through them and help you fill them out so you can use them effectively. Are there any questions before we kind of take off for the evening? Drop them in the chat box if you do have any questions. Okay, well, thanks very much for hanging in there with me. Hopefully this was a benefit to you, and look forward to hopefully seeing or hearing from your new business as it grows. So thanks very much. Take care.